All right, today we're talking SPACs. Think of them as the controversial express lane to Wall Street. For decades, the only way to go public was the IPO. The problem? It's slow and super expensive.
But then, in 2020, this alternative, the SPAC, just blew up. So what exactly is it?
Okay, so a SPAC is basically a shell company. It doesn't sell anything, it doesn't do anything. That's why they're also called blank check companies. Investors literally hand over a blank check. And here's the wild part. A SPAC totally inverts the process. The money comes before the company.
So how does it work? Well, the whole thing happens in 3 main steps. Let's break it down. First, a sponsor, usually a big-name investor, raises a ton of cash from the public.
Then the hunt begins. They've got money in the bank and a ticking clock to find a company. If they can't find a deal in time, no problem. The SPAC dissolves and investors get their money back. Even if they find a deal, investors get a vote. They can get their cash back if they hate it.
Okay, so if investors are so safe, why the crazy boom? It really all boils down to this.
The sponsor can get a massive 20% stake in the newly public company for almost nothing. But here's the catch. They only get paid if a deal closes. Any deal, even a bad one. And this wasn't just a Wall Street thing. It went global, helping huge companies go public fast. You've probably heard of some of them. Grab, Polestar, Swvl, they all used this exact playbook. But this whole boom felt like the Wild West. Companies can make some pretty outlandish future projections. That is until 2024. That's when regulators finally stepped in to change the rules of the game. Basically, target companies are now on the hook for what they say. No more crazy, unchecked promises. So the market has cooled way down. SPACs are back to being a niche tool, not a global frenzy. So you gotta wonder, are SPACs a smart shortcut for innovation or just a risky gamble for investors?